Welcome to Bloomberg BusinessWeek. I'm Carol Masser.
And I'm Jason Kelly, joining you from inside Bloomberg headquarters here in New York.
This week, building on the franchise of Bloomberg BusinessWeek magazine and its rankings of the top global MBA programs, we went to one of the top business schools in the world.
As you can see, we got to have class outside over at Columbia Business School. We heard from the faculty driving the program.
So much fun out there on College Walk, smack in the middle of the university. We also talked with their high-profile alumni that continue to shape the business community, including Morgan Stanley Chairman and CEO James Gorman.
I'd be very surprised at where rates are. I'll just say that up front. I thought the 10-year at this point, I'd expected by the end of this year, the 10-year would be around 3%. I was dead wrong.
We'll hear more from James Gorman and other exclusive chats we had up at Columbia Business School, and many of those topics, they're also covered in this week's issue. I love when that happens.
Me too, as well. And that included a top story this week, the U.S.-China trade war. Gestures of goodwill did lift the financial markets. However, economics editor Peter Coy warns of its unintended consequences.
In a way, it's almost as if the U.S. and China seem to be intent on dividing the world between the two of them, almost into two separate spheres, which is just like really globalization in reverse. And to use a much more recent analogy, it's a little bit like the period after World War II and the Cold War, when there was a Soviet bloc, Comecon, and then there was the Western countries, and not really doing very much commerce with each other, very separate, and that was not good for prosperity for anyone, and the risk is that we're going to go back that way now.
We had some really smart conversations up at the Columbia Business School this week, too, featured, of course, in our show this week, and we talked about U.S.-China trade, and I really do feel it was a consensus that there's too much to be lost on both sides or by both sides if the United States and China don't work together.
That is right. That is except that when you get egos involved, you get other things aside from the economy involved, like national security considerations, then what makes absolute sense sitting up at Columbia and thinking about the economics of it don't play that way in the real world. And what we're seeing is that there's almost like a logic by which the trade war, instead of like cooling off, is heating up. It's like it amplifies, and that could go on for a while longer.
Well, and not only go on for a while longer in terms of the war, as it were, this sort of Cold War that we're talking about, but have long-term, like generations-long structural consequences for the global economy. So much for Chimerica. Right.
Chimerica being the integration of the two economies. And the problem is that trust, once it's broken, is hard to restore. There's, as I said in the piece, there's no just kidding moment where Trump says, forget it, and she says, yeah, let bygones be bygones. I mean,
look at ZTE, like what happened.
ZTE and Huawei, we have two companies, two of China's most important tech companies, both in telecommunications, which are being restricted on purchases of chips, critical components from the U.S. Now, is Xi Jinping going to say, oh, that's not a problem? Or is he going to say, we have to redouble our efforts to develop our own supply chain that does not depend on the U.S.? And as Jason said, that has long-term consequences. Supply chains take a long time to create. There's a lot to it, you know, lining up trusted vendors, having them make the products according to your specifications, and it's not easy to change. We're seeing it now. We're seeing, though, that change happening where the U.S. companies, and I talked to some of them, are finding ways to put plants or move production to Vietnam, Thailand, places in Taiwan, and they're doing it out of necessity, not out of preference.
We also talked China trade with the new dean of Columbia Business School, Kostis Smaglaris.
He was appointed dean over the summer after teaching at the school for 21 years. We spoke with him about how the trade war is impacting students crossing borders and the cost of an MBA degree, asking, is it worth it?
We're constantly looking at the cost of the education, and we're always trying to take cost out of the equation. We're also working on providing good financial aid to our students to essentially facilitate that investment on their part. And we're really focusing on the value of the degree. So I think actually, because business is undergoing quite a bit of change right now, it's a great opportunity for us to innovate in the value that we offer to our students. And in fact, I actually believe that the MBA degree now is a fantastic investment, both in terms of time and return, simply because you need new skills to succeed in practice, and that's what we're striving to do here. So I actually think that the degree is pretty robust, and I think, in fact, because of the change we're undergoing, it's actually more valuable now than it potentially was 5-10 years ago.
So as those business leaders, especially here in New York City, alum include James Gorman from Morgan Stanley. He's going to be with us later on.
Yes.
When he and his friends and fellow alum are visiting with you, what are they asking you for that may be different than what they've been getting in the past in terms of what you're teaching or the types of students that you're turning out?
Yeah, so I think when you talk to business leaders, you realize that they're encountering two things. First of all, technology, data analytics is really changing the way their business is being transacted. So they live that for quite some time. They also understand that the nature of the MBA jobs, the types of jobs that our graduates are going to do, is itself changing over time. So they want to see in what way are we going to best prepare students in order to really participate in that digital future. So they ask, what are we doing in the curriculum? What are we doing in experiential learning? How do we bring MBA students together with engineering students so that they learn how to collaborate, because that's what they're going to do when they go out to work. So these are the types of things we talk about.
I'm also curious how much you talk about the U.S.-China trade spat and what that has done to students who want to come to the Columbia Business School to get a degree, but they're nervous about, what does this mean? Can I stay in the country? Can I create a company? So I'm just curious if you're seeing pushback or a decline in students from overseas that, want to apply.
So for now, at Columbia, we haven't actually experienced that.
No change at all?
Almost no change. We continue to have about 40% international students. About 2/3 of them, about 60% of them that just graduated that wanted to stay in the U.S. actually found jobs in the U.S. And of the 40% that left, I think a lot of them actually wanted to go back in different areas of the world. Having said that, our service economy here in the U.S. depends on really high-skilled human capital. So this is a problem that we need to solve, not just for business education, but for essentially training any type of high-skilled labor that we would like to retain in the country. And hopefully we'll get to have the dialogue and then move to a solution.
And coming up, more on President Trump's trade war, how it's hurting U.S. manufacturing and possibly his chances at re-election in 2020.
Plus, more from our special at Columbia Business School and our exclusive interview with alum and Morgan Stanley Chairman and CEO, James Gorman.
This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Masser. Join us for Bloomberg BusinessWeek every day on the radio starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast on Apple Podcasts, SoundCloud, and Bloomberg.com, wherever you find your podcasts.
Wherever you get them. And you can find us online at businessweek.com and through our mobile app. So, Carol, turning to economics, recession already gripping corners of the United States. That could signal trouble for President Trump come the election next year.
Here's this week's Business Week Explainer. China's often seen as the boogeyman that stole America's factories, but the reality is this. The fortunes of many U.S. manufacturers are linked to China. Look at Cummins, the Indiana diesel engine maker. In 2001, the year China joined the World Trade Organization, Cummins had $5.7 billion in sales and operated at a loss. Last year, it posted $24 billion in sales and a healthy profit. Cummins makes and sells 40% of its engines in China. Cummins CEO calls the trade war with China a gigantic tax on the U.S. economy. The company expects to spend $150 million on tariffs this year. One thing's certain, the surge in manufacturing jobs the first 2 years of the Trump presidency has now gone into reverse in some places. In 22 states, the number of people working in factories contracted the first 7 months of the year. A key battleground state, Pennsylvania, lost 8,000 factory jobs. The big question, Will voters blame the trade war, or will they agree with President Trump's blast at badly run and weak companies? And for more on how U.S. manufacturers are impacted by the trade war with China
and how it might impact President Trump's 2020 re-election bid, here's reporter Sean Donnan in D.C.
It's always hard to tell. We're still a long way out from this election. It's worth remembering that Canada next door is just launching an election campaign, and that one's only going to take 41 days. Ours is a lot longer, obviously, and there's a lot that can happen in the economy in between. But if you talk to manufacturers, they see things getting worse, not better, over the next year. That is bad in industrial states like Wisconsin, like Pennsylvania, like Ohio, like Michigan, like Indiana, all of which were pretty important for Donald Trump in 2016. We're already seeing the manufacturing jobs growth that this administration was able to crow about in the first 2 years slow down markedly. In places like Wisconsin and Pennsylvania, it's actually gone into reverse. Pennsylvania's lost 8,000 manufacturing jobs in the first 7 months of this year. And things, again, are not going to get better. That should bode badly for the president politically in these industrial states, but as we know, Donald Trump seems to have an ability to write out a lot of things.
Well, and this is what's interesting, and this is where the story gets political, because as you point out, Sean, in your story, there has been a manufacturing job gain since Donald Trump took office as president, but the point is those politically important states, and there are a lot of them that he did well the first time around, their manufacturing job gains are slowing down.
Absolutely, and I think sometimes the direction matters more than the long-term gains. In President Obama's second term, the U.S. actually created a lot of manufacturing jobs. Between the trough in 2010 and the end of his administration, the Obama administration saw something like 900,000 more manufacturing jobs in the United States. But in 2016, that all-important election year, the U.S. lost 30,000 manufacturing jobs, and that makes a difference, and that meant a lot of people in those swing states and that kind of industrial heartland weren't feeling as good about where they were or where they were going than they were in years beforehand.
Hey, Sean, one quick last question. Manufacturing jobs, the manufacturing sector, as important to the Republicans as it is to the Democrats, or that's different?
That's a really interesting thing. We often associate, or historically have associated the manufacturing sector and manufacturing workers, that kind of blue-collar icon of the American economy, with the Democrats and labor unions. Actually, if you look at the exposure to, particularly in those battleground states, counties that went for Donald Trump tend to be more heavily exposed to manufacturing than counties that voted for Hillary Clinton. And that means that if you get this downturn in those counties, that could hurt Donald Trump more than it would hurt a Democratic challenger.
Now, as for who's truly feeling the brunt of the trade war,
we go back to Columbia Business School. More special coverage. We spoke there with Professor Amit Kandwal. He's an expert in international development and economics.
There's kind of a sequence of events that happen. So one is the tariffs are tax on imports. Consumers are going to start to see potentially rising prices on imported goods, so they should kind of switch towards domestic goods. And so that means that there's going to be a transfer from U.S. consumers who are potentially paying higher prices to U.S. producers who are potentially benefiting from higher prices. And then the government collects some tariff revenue. And so one of the goals of this exercise was to kind of calculate what is the overall effect and what are the transfers that are going on. One of the surprising things that we found in this research was when you look at the data and you kind of charted the time path of what happens to goods that are being targeted with tariffs as they come into the U.S. is like a really important number for an economist is to understand what happens to the prices of those goods. And we have heard from the president, for instance, who says that the Chinese will be paying for the tariffs, and in principle that is possible. And the way that could work is that if the U.S. imposes a tariff, the Chinese exporter may lower her price down to such a point so that the post-tariff price actually doesn't change for the U.S. consumer, and that's possible, and that would be a condition under which the Chinese is essentially eating the tariff. But when we look at the data, that's in fact not what's going on. The split, of course, could be anywhere between 0% and 100%, and what we find is that the U.S. consumers or the U.S. economy is actually bearing the full incidence of the tariff.
Coming up, more from our visit to Columbia Business School, chatting with faculty, and our exclusive interviews with alumni Lou Wong. She's the founder and CEO of Tupelo Capital Management.
And also Morgan Stanley Chairman and CEO James Gorman. This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Masser. You can also listen to us on the radio on SiriusXM Channel 119 and on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital, and through the Bloomberg Business app. Well, we continue with our special coverage from Columbia Business School, building on BusinessWeek magazine's Best B-School rankings. We went up to one of the schools that is always on the list to speak with faculty driving the program and its high-profile alumni that are shaping the business community.
Among them, Lou Wong, founder and CEO of Tupelo Capital Management. She's a pioneer on Wall Street. She graduated from Columbia Business School in '83. She has been in financial money management for decades. We spoke with her about the global economy, the ongoing unrest in Hong Kong, and bridging the U.S. and Asia.
I think it's a very fraught situation, and I hear from friends and colleagues on both sides, and they're both equally grieved. And I think the way it works out is that I don't think Beijing realized it was going to go this far. I think they certainly do not want to have a Tiananmen Square. It's a very different world we live in, social media. They cannot have that. So they have to find some face-saving way to begin to calm the crowds. I think, fortunately, the beef that the demonstrators have is really more with the Hong Kong government than with Beijing. So I think if we can work through Carrie Lam, she has already withdrawn the extradition bill, and if she can begin to negotiate on the three other conditions that the protesters have set up, there is a potential to work through some understanding.
Lulu, is there a role for folks outside of Hong Kong and outside of China? Because there's certainly been some push among the protesters to involve the United States. What's your role on that, or view on that?
I do think there is a role. In my not day job, I'm also on the board of Asia Society, which is really the foremost nonpartisan group trying to bridge U.S. and Asia. And we had been very busy talking to both sides about the issues. I think if we can find ways, the Chinese are very big on faith. They cannot be humiliated. And if there's a way in which they can continue to stay with the one country, two systems, begin to exert some control over Hong Kong, but not with the heavy-handedness we've seen, I think there will be a solution.
Business leaders and certainly investors are talking increasingly of a decoupling between the United States and China. Given you've spent decades coupling the U.S. and China in many ways, how much do you worry that may become a reality?
I think there are many people who are concerned that this is going to be one win, one lose. I still am a believer that it can be a win-win situation. I think right now we have two leaders who are both under short-term pressure to try to resolve some of the problems before their economies crumble. I think the advantage that Xi has is that he also is playing the long game. And I think he believes that the long-term future of China is very conditioned on China retaining economic, political, not necessarily military, but geopolitical power. The question is, does the economy crumble before he can achieve this? But he has many levers that are not present in America.
Which he's been pulling, especially this week we've seen.
He has been pulling levers. He's moving more liquidity into the system. He's getting some of his companies, both multinational and Chinese, to begin to try to do more investing in the economy. He's trying to bring more capitals investment back into China.
Lulu, I'm curious though, what you are hearing is that are the expectations from U.S. folks that you're talking to, folks in China, that there will be some kind of trade deal that's done? Or is the fear that I think we keep hearing is that we're going to see China kind of go off with their plans and have its allies, and the U.S. will go off on its plans, and when it comes to trade and developing technology, what do you expect?
I think it'd be very difficult for there to be two fortresses. The world is too connected. The supply chain, the markets, we are interdependent. So I don't think we can truly exist separately. I do think that some of the reforms that the U.S. is pressuring China to make are not actually bad for China. Some of the progressives in China have been militating for them all along, but they had been sort of outnumbered by the hawks. But I think with this current situation where she's under pressure internally for having managed it in an indelicate way, is going to provide some opportunity for the progressives to say, look, it makes sense that we open our markets. It makes sense that we liberalize. And so let's do some of this. We will make it appear that it is our own initiation. We're not being bullied into it. That's very important. The West has to not play the bully hand. I think that will be very difficult for Xi to overcome. But if there can be sensitive diplomatic accommodations on both sides, I think it could come out better for both countries.
One of the biggest concerns for investors, sort of broadening to the entire world, Lulu, is this notion of negative yields, a world where pensions and other huge institutional investors are just not making the money they need. Do you see a short-term change in that? You're so involved in so many of these big institutions as customers and as an advisor.
Right. Well, I think there's a lot of liquidity around. There is money to be invested. And in a way, that's why many bears on the U.S. market are puzzled and frustrated that they've been short and the market continues to just want to work its way up. So that money wants to find a place. And in this very troubled world, the U.S. and the U.S. dollar seems to be a relative safe haven. So I think if we can find some stabilization of the economic situation, that money can go back to work. The U.S. certainly needs to have a capital cycle. We have not been investing in our capital and equipment. So I think if we can just get some predictability, stability, I think both China and the U.S. and other countries can put money to work for the economies.
Just have about 30 seconds left here. We'd be remiss not to ask you just generally, too, a little bit about your market outlook. People are talking a lot about recession. They want lower rates. In just about 30 seconds, how do you see the economic outlook and the market outlook?
I don't think we're headed into a deep recession. I think we are clearly in a slowdown. And when that happens, you get a lot of panic. And certainly the geopolitical situation is very troublesome. But I think the incredible volatility gives investors great opportunities. When I see a down 800-point day, I am just licking my chops. I'm looking at my list of stocks
so
I
you're
enjoy.
Buying.
Oh, into the corrections. Yeah. And then you get another 800-point swing the next day. If I have some stocks I'm not so comfortable with, it's a good chance to clean house.
Coming up, Columbia Business School alumnus class of 1987.
We're talking about our exclusive conversation with Morgan Stanley Chairman and CEO James Gorman. This is Bloomberg BusinessWeek.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Welcome back to Bloomberg BusinessWeek. I'm Carol Masser.
And I'm Jason Kelly. This week, a special visit to Columbia Business School to hear from top faculty and high-profile alum.
Building on a franchise of the Bloomberg BusinessWeek magazine, a ranking of the top global MBA programs, we went to a school that is always on that list.
Here's BusinessWeek editor Joel Weber.
what we really have, the thesis here is that the nexus that you get between the business schools and the alumni networks and the students that are coming through, that's why people come to business school. You get a crash course in the greatest business curriculum you can get, but then you also get the case study feeling that comes from real world applications. So for us, we look at that, we look at the stories we do in many ways as case studies. And kind of making the world of business come to life via story is what we do in the Pages of Business Week, which is not that dissimilar from what's happening in a classroom setting either. So for us, this just feels like the water that we swim in and the air that we breathe in. And Columbia really embodies the spirit because of, we're witnessing it here with Mr. Gorman today. Like, this is a powerful place to play.
Well, I think about the surveys that you guys do, and you really kind of dice and slice what goes on in a business school community. But it is interesting because you figure out the nuances that kind of make each MBA program distinct. One of them about Columbia is, here you are in New York City.
Yeah, so New York City is part of it. I think the big thing that we really leaned into with the way that we've done rankings, and really why, 30 years into this, we've doubled down on it and really found our DNA with it, which is data. And leaning into how do we make this data set be extraordinary.
New York City obviously is a big piece of it, but what is it about this place?
Well, I'll bring it back to their tagline. Have you seen that one yet? At the very center of business, right?
Yeah.
I think that really does embody it, because here we are in New York. You can't imagine a better setting for a business school when you have the real world applications that are right outside your door.
And now to a high-profile alum of the Columbia Business School and a leader in the financial community.
We're talking about James Gorman. He is the chairman and CEO of Morgan Stanley, class of '87 at Columbia Business School.
I came here to sort of change careers. What I remember most is the interest rate on my student loan. Was 24%, which I think is a world record, right? And I thought I'd died and gone to heaven, because America welcomed me to come here to learn, to grow, and it was unbelievable. I arrived on a very hot August day, August the 2nd, 1985. It was that classic New York sweltering heat, and it was all new. It was so exciting, and the campus, this university, which is extraordinary. I couldn't have been happier, honestly, to be given that chance, and that's why I think immigration, welcoming foreigners, giving them an opportunity to contribute, and I'm still here.
Right.
30 plus years later.
Well, let's talk about the markets. You're in it. We obviously watch it day in and day out. There's so many big macro stories that are out there, whether it's Brexit, whether it's U.S.-China trade. How do you see the market, the global market environment right now?
Well, it's a conundrum. At one level, we've got record low unemployment. We do still have global growth. The U.S. economy, the most important economy in the world, is performing strongly. China's still performing strongly. Europe is obviously mixed, but it's been mixed for 2 decades now. So at one level, the fundamentals are actually quite strong. At the other level, the sense of confidence, there isn't the confidence, and there's this sense of inevitability. We're at the end of a cycle. It doesn't have to be. Statistically, there is a recession every 7 years, right? Each year you begin with a 15% chance of recession, but it doesn't have to be. In Australia, they haven't had a recession for 28 years in a row.
Right.
So
Why is there so much pressure, though, then on the Federal Reserve to continue cutting rates? Does that make sense?
Well, because the economy is slowing. Okay. The economy is slowing, and the job of the Fed is to sort of balance monetary policy with economic outlook and fiscal policy. And they should feather rates. Obviously, when the economy is getting hot, their job is to raise rates, slow it down, and the reverse. So, I've supported the latest Fed rate cut, and I suspect they'll do 1 or 2 more. But then it's time for a pause and really absorb this, because the problem with cutting is it's one of the few tools you've got. So if you give it away too easily, what do you have if we have a real problem?
I want to go back to something you said a minute ago, sort of squaring some of the different elements out there, and especially businesses that certainly seem more cautious with a consumer that isn't showing much signs of caution at all. How do you square those things as you talk to your customers, and what do you see out there that could help explain that dichotomy, as it were?
Well, we're in a bit of an echo chamber. If you're a business leader, you go to business leadership meetings, we all talk to each other, we sort of, we bounce off each other. So a little bit of it is, gee, we must be at the end of the cycle. The Fed's cutting rates. We must be about to have a recession. By the way, we've had an inverted yield curve, which has been highly predictive of a recession. So there's some hard evidence that things are more likely to slow down than accelerate at this point. I don't think there's any doubt about that. So as executives whose job is to think about capital investment over multi-years, you would be prudent in being cautious at this point. There's nothing wrong with that. Consumers aren't yet experiencing that. They've got very cheap debt. Housing is starting to recover. Their consumer credit, apart from student loans, sadly, is in very strong shape. So the consumer balance sheet is still very strong, and that's why it's lagging where the corporate balance sheet and corporate attitude is.
Are there implications, though, from having rates at such a low level for such a protracted time?
I mean, it's all about finding equilibrium between economic growth and the cost of money. So, I mean, there are only implications if it creates a bubble, right? That's cheap money eventually will create a bubble. We're a long way from that now.
You don't see any of that?
No, I'm seeing no bubbles.
And how do you manage your business given all of those different inputs and outputs that's in? Where do you hire? Where do you maybe stay steady? Where do you invest across the empire of Morgan Stanley?
Empire. Never thought about it that way, but yeah, we're just a simple business. You know, firstly, we're very long the U.S. Our wealth management business is, I think, 90+% U.S., and at least half our securities business here. So that's a good thing, right? This is an $18 trillion economy, strongest economy in the world, most important economy in the world. I'm happy to be long the U.S. We're obviously, you know, we've been aggressively building our Asia business, which is now, I think, 14% or so of the company. With the trade talks, things have slowed clearly across parts of Asia. So that's to be played out. But our job is to try and look past 1, 3, 6 month hiccups or slowdowns. Our job, certainly my job, is to think out 5+ years. And, you know, traders are thinking every 5 minutes. I'm trying to think 5 years. And
Can you do that in this environment, though? Because it does feel like we've been going back and forth on, let's say, U.S.-China trade.
You've got to. We've been around for 85 years. I mean, we're managing 2.6 trillion of people's money. They're not all selling into the market on one day and all buying on the next day. No, things actually move in small increments. It's more things like the public markets and companies going public that, you know, or M&A transactions happening or not. But most of our core businesses are relatively immune to what's going on right now. You wouldn't see the impact on our wealth management business greatly at all.
Well, let's talk about the public markets because it's been quite a year for.
Gave you an opening there.
You really did. You just like
drive the trucks
right up there. I mean, the public markets have really been something to watch, to say the least, and especially talk about cognitive dissonance. You know, between sort of private market valuations and public market valuations. What do you see going on there? Why is that happening?
Well, on the other hand, the public markets are record highs.
Right.
Right, so where is the dissonance?
The dissonance is in the IPO markets in some ways, you know, some of these mega unicorn companies going public.
Yeah, I mean, listen, there's rounds of fundraising. Companies have tended to go public later and done, you know, 4, 5, 6 rounds. With that comes some risk, obviously, because you've got a lot of investors who've come in relatively late before you go to full public market, and I think we've seen that in some of these companies that look like they're going to go public now lower than what the last couple of rounds were raising. That's unusual. We haven't seen that for a long time. It's also a function. There was some very frothy money floating around in the early rounds.
Has that changed, do you think? Do you think the private money's getting smarter at this point?
I think the market's pretty efficient.
Yeah.
You know, these people aren't stupid who are making these investments. These are very savvy people, and listen, this is sort of the corrective mechanisms that occur. They see a couple of companies go public at lower than whatever their last valuation was. That's a good corrective mechanism. That's okay. Back to the bubble question. That pinpricks the bubbles that are out there.
And you can hear all of our exclusive interview with James Gorman, Chairman and CEO of Morgan Stanley. That's on our extra podcast. We talked about so much.
It was wide-ranging. Yes. I mean, from how he lived when he was at Columbia, who he was living with, to things that he's doing now at Morgan Stanley as it relates to the markets, even creating a more diverse bank.
Yeah, I thought that was really telling. Really great stuff.
Still ahead, more from our visit to Columbia Business School.
We'll speak with Yukes Net-a-Porter Group Chairman and CEO Federico Marchetti on his time in the program and getting a head start in online luxury.
Plus, we step off Columbia's campus for a look at another university's endowment, the money manager that's in charge of Yale's fortune. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. Join us for Bloomberg BusinessWeek every day on the radio, starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast. Find that at Apple Podcasts, SoundCloud, and Bloomberg.com.
And also find us online at businessweek.com and through our mobile app. Back to our visit to Columbia Business School. It's always on the list of BusinessWeek's top MBA schools around the world. One reason why is the faculty.
That's for sure. Here's Assistant Professor of Business Sandra Motz, an expert in human behavior and psychology in the world of business.
When people ask me, well, your degree is in psychology, what are you doing in a business school? And I think my answer is usually, well, like there's people working in organizations. Not sure if you've noticed, but it's groups. There's group dynamics. It's interesting to see how do people select into organizations. What makes them happy at the job? What makes them productive? So there's a lot of psychologists trying to understand like the dynamics that are going on within organizations.
So give us a sense of an assignment or an exercise that you might give in this class.
So we do a lot of cases, and I think that's what students benefit the most from, is we throw them into a situation, we tell them, just this is a role, take it on, assume that those are your own preferences, and now go and negotiate. And I think the biggest learning that they get is really the feedback from the other students.
Right.
So they're like, wait, like I lost so much money on the table, I actually felt pretty good about the outcome, like after the negotiation, but now that I see what the case was actually about, maybe I see I could have pushed a lot harder.
Yeah.
So I think it's this feedback that they get from the students, and also just seeing like how well did I actually perform in the negotiation.
We turn now from Columbia, but don't despair because we're staying in the Ivy League. We have a story about Yale. It's in this week's issue. It's about David Swensen, a legend at the university and its highest paid employee. He's also the money manager who for 34 years has been in charge of the Yale Endowment.
One of the best known and most successful out there. Here's reporter Janet Lauren on how Yale got crazy rich.
So he has been the chief investment officer at Yale since 1985, which is a really long time.
Yeah.
And if you think about what the world was like in 1985, Yale was mostly invested in stocks and bonds. And to be diversified was to be diversified among stocks and bonds. And he really changed that world. You know, you think of private equity today and hedge funds and venture capital as just how institutional investors invest, but that really was in some ways because of him and how he sought these out. And you think about private equity where money is going to be tied up for years, in some case maybe a decade. And if you're investing for centuries, which is what Yale and endowments are doing, you can afford to have that money locked up. And there is the liquidity premium. Now, of course, we all know this now today.
Right.
But back then, that really wasn't how things were done.
It's kind of akin to, you think about the junk bond market. It's such a part of normal investing today, but when it was created, you know, several years ago, it was considered innovative. And that's kind of where he was coming from.
Yes. And, you know, he cautions you can't replicate this. And we have a great quote in our story from Charlie Ellis, who is the longtime chair of the investment committee. You know, you can't replicate 35 years of this, building up the networks. And the network is what's really important. The network of outside managers, which Yale finds the best managers to manage money in various strategies. And that is how it's done today.
Up next, more from Columbia Business School's high-profile alum.
We'll hear from two former students turned entrepreneurs.
We talk luxury e-commerce with Yukes Net-a-Porter Group chairman and CEO.
And building a brand with the founder of Siggy's Icelandic yogurt. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. You can also listen to us on the radio on Sirius XM Channel 119, also AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital, and of course on the Bloomberg Business app.
Well, Columbia Business School, it's a top MBA program on BusinessWeek's Global B-School rankings.
And our coverage from the school continues. We sat down with notable faculty and high-profile alumni. One of the alum, Federico Marchetti, was ahead of his time when it comes to online luxury retail. Well, today he is the chairman and CEO of Yukes Net-a-Porter Group.
At Columbia, I studied, for example, my favorite class was retailing because I love the customers. And retailing with Professor Alan Kane was like an amazing class. I remember also like that I interacted with Michael Drexel, that he was a lecturer. And we emailed each other like an analysis about the Italian market, because Gap at that time, he was the CEO of Gap, it was not in Italy. So, I mean, the exposure that as a young student that you get with Mickey Drexel, that he was like a hero for retailing. And then I took entrepreneurship classes. I did my business plan about a fast food environment with slow food as a content. And then actually it's a concept that has developed recently very
Talk
successfully.
about ahead of your time. I mean, we're seeing a lot of that right now.
But then I realized that I didn't want to be behind the counter and preparing food for the 20 years. And so as an Italian, going back to Italy after my MBA, the competitive advantage of the Italian are like the 3 Fs. Now it's food, fashion, and furniture. And so food
was out.
Furniture, fashion was probably the right thing. And so what I basically, you can say that I had a vision, in the sense that I thought that fashion and luxury one day was going to converge with the internet. In '99 they were completely two opposite worlds. They didn't talk each other, they didn't like each other. So my role in the last 20 years has been as a trade union, as a link between these two worlds. And now.
But who would have thought, Federico, that you would spend, thousands of dollars for a high-end piece and buy it online? Like, it's pretty remarkable.
I invented Yux as the shop of my dream.
Yeah.
And so I'm always, more than a chairman and CEO, you should call me customer number one.
Yeah.
And
what you wanted.
All the strategies is like I put myself in the shoes of the customers. And I thought that it was, why not? I mean, like, and not only like bags and shoes, but also ready to wear now, which can be counterintuitive. And then in 2016, after having convinced all the fashion brands to go online in the last 15 years, in 2016 I thought that maybe it was time also to convince the hard luxury, and so watches and jewelry. And now, like, the price is not a limit. So, like, there's no limit for pricing. So we are selling watches and jewelry over $200,000.
Luxury seems to be having something of a moment right now, and we were just talking last week with the author of a new book called Fashionopolis that's basically essentially sort of rejecting the idea, the economics of fast fashion, this idea of, the opposite essentially of what you do. Do you feel that society is moving toward a place where it values things a little bit more and thinks about all aspects of a product?
Really going back to quality versus quantity to some extent.
Yeah, I mean, listen, when I was here at Columbia, like when I started to put together the business plan of Yux, I always wanted to create something that was sustainable and it was good. And that's why, like, very early on, in 2008 to 2009, I launched Yuxigen. That was a complete sustainable fashion area within Yux. And now with Net-a-Porter, we have Net Sustain, where basically we're showcasing all these great designers launching sustainable fashion.
There's lots of demand for that.
And that's what the customers want. 2009, I was probably just a little bit early.
Right.
Now we are perfectly on time, but it has been like 10 years that we are developing, so we have a huge advantage compared to everybody else.
Another Columbia Business School alum who also is behind a well-known consumer brand is Siggy Hilmarsson.
Well, he's founder of the growing and popular Icelandic yogurt company that bears his name, Siggy's. He talked with us about how Columbia's MBA program made it all possible.
One of the most important things that I learned from Columbia was actually supply chain, but that was kind of almost by luck, that happened. So very thankful.
It feels like you did, when you created this company, anticipate a place where we are now when it comes to food and ingredients and people's willingness, candidly, to pay up for high quality and to really care about where their food is coming from. What did you see sort of looking around the corner that convinced you that this was the way to go?
Oh, that's pretty easy to answer. When I came here, I not only missed Skyr, the Icelandic yogurt, I noticed that a lot of the yogurts here were very sweet.
Yeah.
And the most popular yogurt in America at the time had more sugar per ounce than a can of Coke. And the difference between Coke and yogurt was that, people drink Coca-Cola and they kind of know it's not healthy, but they do it anyway, right? With yogurt, it had the halo of a health product, so people were totally indiscriminating of eating it, even if it contained more sugar than the Coke, right? So I thought this is like a contradiction here, like people need to know about this and I need to do something to fix it. So when we started the company, I wanted to make the yogurt, but not make it so sweet that it was equivalent to candy or soda. And that was a challenge. People were sort of not super receptive at first, but then it really took off sort of 2012, 13.
Fast forward, you've got this company, people are like, yeah, I don't need all that sugar, I need just kind of healthy ingredients in something. There's more competition. So how do you continue to get the shelf space and set yourself apart?
Well, we were very lucky in that regard because when we started, nobody was focusing on that. And the weirdest thing I actually found was that we didn't get a lot of competition. We heard sort of rumors that some of the big companies looked at our space and said, people are not going to like that. Oh, this is a cool little brand, but people are not going to like it. It's not sweet enough. And then all of a sudden, we sort of are starting to have a meaningful share of the US grocery market. First 1%, then 2%, then close to 3%. And then sort of the competition came in.
Your advice to other entrepreneurs, and just quickly.
Plan for success. There's nothing worse than having the demand and having the things out there that people want your product and not being able to supply them. So build the infrastructure.
Bloomberg BusinessWeek is available on newsstands now.
Also online at businessweek.com and, of course, on our mobile app.
And across all those platforms, you can find this week's cover story. Can you trust generics? 90% of the pharmaceuticals sold in the U.S. are generics. And the FDA, it's waking up to a quality control nightmare that may be putting your health at risk. Here's reporter Anna Edney in D.C. with a sneak peek.
While we're highlighting this one company and obviously this one very big consequence that has affected millions of people, there are others out there that are going through and some of the same issues, and we just don't know exactly yet how big the extent of this could be.
And you're talking about the companies that make generics that are sold to the world, correct?
Exactly. A lot of our generics, and particularly the active ingredients that are used in those drugs, are made in China. So 80% of active ingredients for drugs that are taken in the U.S. are made in China or India. And what happens is, you have a company in either of those countries who can make the active ingredient a lot cheaper, and they sell it to big companies. In the case of the Chinese company, Zhejiang Huahai, they sold their active ingredient for these contaminated blood pressure pills to really well-known, very big drug makers. Teva Pharmaceuticals comes to mind.
And check out our daily Business Week podcast, as well as the full versions of all of our exclusive interviews from our special coverage from Columbia Business School. That's available at Apple Podcasts, SoundCloud, and Bloomberg.com.
More Bloomberg Television starts right now.